So today topic is reversal signals. So today what you will learn, I'll show you the chart of an emotional roller coaster of trading, what goes on in trader's life. It could be one symbol or it could be overall market. So I was showing you the chart. I'll show you again. I got it from somewhere. And then I'll explain to you the stages of market life cycle. So there are 7 stages, and depending on where the market is, or that's when I say market, it means it could be the whole market, or it could be just one individual symbol. So I'll explain to you. It's a big topic. I will just explain to you briefly, but it's a big topic from market life cycle, individual stages. So what do you need to do in individual stage? So number 3, types of reversal signals. So I'll give you some reversal signals, show you the bearish signals and some bullish signals. So again, it's a big topic. You can spend your life identifying it, or you can learn it in 1 year, 2 years. It's not about year, 1 year, 2 year. It's about number of hours. So how many hours, the quality hours we spend in learning. So you can stare at the screen whole day, on your laptop monitor and learn nothing, or you can spend 2 hours of quality time on learning and applying the knowledge. So during the market hours, after the market hours, before the market hours. So it's different. When the market is moving, it's a different kind of a feeling, um, different knowledge. And then when market is closed, then it's different. Then I will explain to you trading strategies for reversals. So this is where I will show you 3 charts of bottom reversal and 3 examples of top reversals. So these reversal charts are generic in nature. There is no price, there's no indicator in it, just pure charts. So just some examples. So here is the stage of market life cycle. So I color coded in order to distinguish. You can see clearly what are the different stages. So as you can see, this is red, indicated in red. So it's a market downfall indicated in the stage 1. Number 2, it's less, it's like orange. So it's less, the downfall is there, downtrend market, but it's less severe than number 1. Then we see slight green, so 3. So it's uptrending, started to move, and you can see there's a V shape or U shape reversal going on, and a slight green. So this happen every day, overall market every week, or maybe every 2 months, 3 months, so depending on the overall market or individual symbol. Then this is a stage 4, which is parabolic move. So this is very highly bullish move, denoted in stage as if number 4. Then there is number 5, which is even darker, and it's uptrending market, and it's even darker, number 5, indicated in number 5. Then number 6, orange, so it's a downtrending, but it's just not much selling pressure. So the big boys are selling here in number 6 stage, number 5 and number 6, and we don't know. So we don't know there's selling going on, distribution going on. And the big boys are buying in stage number 2 and 3, and the initial stages of 4. Retailers are buying here in 5, or at the end of 4. Then there is a severe downtrend, number 1, red. So this is what it is. So after this move up, then another down move. So after stage 1 downfall, then there could be a bottom like this. So I'll explain to you stage 7. So these are the stages we will talk about. Now, the emotional roller coaster of trading, these are some of the emotions I listed here. There are 14 of them, and there could be many, but these 14. So during market life cycle, 14 emotions. So anger, depression, disbelief, and I will show you on the chart where these emotions come. So where these emotions comes, I will explain to you through chart. Also, in your trading journal, if you have a trading journal, so in a trading journal, open date, close date, number of days in the trading, what you bought, how many times you bought, how many days you stayed in the trade, what was the percentage gain, what was the percentage loss, uh, etc. Goes in the trading journal. Besides that data in the trading journal or in your trading diary, you should have emotions. So emotions should be listed there too as we progress the trade. So when you started the trade, what kind of emotion you had during the life of that trade, what kind of emotions you went through, and then when you were closing the trade, whether at loss or gain, what kind of emotions you had when you closed the trade. Not only the emotions, but the thoughts which were going in your head, the internal chatter during the life cycle of that trade should be documented. So then you have a complete journal. So, so if you Google, let's say you Google and say, hey, Google, give me all the emotions a trader go through or all the negative emotions. So the list will come 250 emotions. So you say, damn, 250. So in your journal, you can quote them. So you say, okay, anger 001, 002 depression, 003 disbelief. So all these you can quote those emotions word. So when you have a journal on a drop down, you can pick uh, that emotion. Say, okay, anger was coming or denial was coming. So then once you have that data of your trading journal, then you can run your analysis and say, okay, how many times this emotion was coming, how many times this emotion and what stage. So this, you can do that, or you can just trade on your iPhone, you know. All right. So these are some of the emotions: anger, depression, disbelief, hope, optimism, belief. So there's a disbelief and there is a belief, and then there's a thrill, euphoria, greed, complacency, anxiety, denial, panic, and capitulation. So I'll show you the chart where all these 14 emotions lie. So this is the chart I got somewhere. I did not create. I just copy and pasted here. So you see here, emotional roller coaster, master life cycle, market life cycle. So this is a chart of a major index. So this is a chart of a major index, major market. So here, when the market crash and it start to rally, um, people have disbelief. This rally will fall like the other. So people don't believe in the rally because they've been hurt. So they are not believing in it. You get this word or people having discussion. Um, I don't buy this rally. I'm in the sideline. I don't buy this. So this is what's happening here. We don't understand that this is the bottom, and then market reaches some level. So not everybody is in this market. Only the traders who have the resources, have the knowledge, and others are just in disbelief. They sit on the sideline. Then the market pulled back severely here, and then it started to rise. So the hope sets in, a recovery is possible. So that's where we realize that, okay, there is a hope. I think I should um, get in, start participating. And then when the market start to move in a parabolic fashion, then optimism, this rally is real. And this is where, so this rally is real. This is where they start to participate. Like 40-50% of the traders, they are participating, and time to get fully invested. So think about this: the big boys, if they invested here at this level, we are getting at this parabolic uh, stage. So then belief comes in, time to get fully invested. We are 100% invested in long. So 100% of our portfolio is invested, and we just keep buying, even go on margin. So if we have a $50,000 portfolio, we are invested $100,000. So because we are making money, so why not borrow on margin? And you can see on the TV ad, interactive broker, etc. Invest is us. We give you, we are the lowest, interest charge. People borrow money on their credit card because 29% yearly is interest rate 29.99, not 30%, 29.99. 29.99 interest rate yearly is nothing when traders are making 29, 30% on a daily basis. Options. So borrow on credit card, get some thrill, and start this statement. I'm very pleased with my investment. I'm very pleased with my investment. Time to get in, borrow more money, get second mortgage, etc. HELOC maybe. So do that. Euphoria sets in. I'm a genius because we cannot go wrong. So I'm a genius. One time, my friends, so she has three sons, two sons and one daughter. So I watched them grow. Then the son, Kevin, he turns 18 or 19, whatever age he reached. And then one day she sent me a message, hey, Kevin is also trading. So I know Kevin. He grew up in front of me. So I told my friend that, hey, Andrea, let me know how long it lasts because everybody is a genius at this time. So he don't have uh, the knowledge. He just buying Tesla or whatever and just doubling it down, make 2,000, then goes to 4,000, and invest 4,000 and 6,000. So in few months, wipe out. So euphoria sets in, and we take greed sets in, and then high level of financial risk. So everything is on the table. And then when the market pulls back, the complacency kicks in. We just need to cool off for the next rally. So um, don't believe in this severe downturn. And when the market rallies, so this is where the traders get trapped. You see this high. This is where the traders get trapped. This is where the market has topped out. And then when it crashes and bounce back up, trader double down in this stage. They double down. They double down, or they are buying on the dip. So this is where uh, trapping the leftover money. So the leftover money for in a doubling down, or those who are not in the market comes in and trap all the other uh, traders with the leftover money. And then market suddenly crash, and then anxiety sets in, and the denial sets in, the panic sets in, and the capitulation, and then the market goes on the sideway motion. Anger sets in. Who shorted the market and this and that? They are out there to get me. And this is stage one again. Best time for investing. This is where the stage one comes in. People in the capitulation mode. This is where um, uh, in the people are throwing the towel. The traders are throwing the towel. The margin calls are coming in, etc. So everybody gets out, and then they either wiped out their portfolio, or it's 50% haircut, or whatever it is. And anger sets, don't want to participate again, because anger, this market is out there to get me. All kinds of negative emotions and beliefs sets in. And this is the time. Another stage one is not the stage one, sorry, stage 2 and 3. This is where the stage 2 and 3, but most of the traders are in depression mode. And when the market is rallying again, they are disbelief. They're in disbelief. They don't want to participate. They want to participate in this stage, thrill, when the thrill comes. So knowing this, these emotions, 14 emotions are on this chart. I'll show you again this, break it down into simple 7 stages. To break it down into simple 7 stages, the stages of market life cycle. So these are color coded. So this is where the decline is happening in overall market or just one market. And then when when nobody is left, then if somebody wants to sell, then another person wants to buy. So this is where the deep pocket are accumulating. So accumulation goes on. So market creates a low and then doesn't want to go down. So it either creates a new low nearby or a higher low, new low nearby or a higher low. So traders try to short this market and they are getting clobbered. The shorts are not working or puts are getting expired. So this is where, because somebody knows the value of that stock, so they are accumulating it. So if we in this stage two, if we are buying options, then even if we are buying long calls, unless we have a deep in the money and a long-term calls, this the market will rally, but we will run out of time, or time decay kicks in that the market option doesn't have any value left. Even we see the market moving up. So if we have deep pocket, we can also do the bottom fishing. So this is where the bottom fishing goes on, accumulation. So they call it bottom fishing. So stage two is not good for retail traders because there's a cost of funds, lost opportunity. So we shouldn't be investing in this stage. It's not advisable to invest, even if you have a lot of funds, unless you have billions of dollars and you believe in it, you have resources. For us, we shouldn't be investing long or short when the market is in stage two. If uh, so, when stage three is where market is making market start to show through some sign that the bottom is there, because market doesn't want to go any lower. So this is where we can start buying, uh, even not shares. If we buy options, we need to buy in the money, uh, and a lot of time, if you believe that this is the bottom. So stage three is where the accumulation sets in by the big boys. So 2 and 3 is the stage. The real is the stage 3, because in 2 the market is still going down but less severe. The stage 3 is where the bottom kicks in and no lows, higher lows are being formed. The market comes down and then go up, come down and go up. The stage 4 is, this is where the catalyst comes in. So a new catalyst comes. If let's say a symbol, I give you example of Chipotle. So there was a time when Chipotle had news of all those kinds of food poison, and then the new CEO comes in. So the market gaps up. So this is where the consolidation is happening, and then when the market gaps up, some kind of a reversal signal comes in. So this is where the reversal signal comes, and after the reversal signal, so reversal signal, and then after the reversal signal, there is a secondary confirmation. This is what happens, the secondary confirmation. So reversal comes in, signal, you detect the reversal signal. Either you initiate a position a little bit, just dip your toe, and then so if you dip your toe here, based on that reversal signal, the secondary evidence tells you that this was real. So, and if you cannot, then participate in this market, in this rally. So this phase 4 is long. The phase 4 is long because market take time to move up. So the time to take for the market to move up, it's longer than the time for the market to come down. That's why you see in stage 1 have a shorter duration, whereas stage 4, the market rallying, have a higher duration. So this is, if you look at it from the time point of view, this is longer. But in between 4, it's not parabolic. In between 4, there are pullbacks. So there are pullbacks, dip, move up, then there is another gap, pull back, then rally. So there are a lot of things going on in the phase 4. Most of the money is made, if you are sharp enough, most of the money is made in stage 1 or stage 4. So if traders are disciplined enough, they only should participate in when the market is in stage 4 or stage 1. Other stages, they just ignore it. Or if they are really shrewd, then stage 3 and stage 6. So initiate a position in stage 3 a little bit, stage 3 and stage 6, participate in stage 1 and stage 4. So this is where the market moves in a parabolic. A lot of money can be made if the market, there's certain stages of the market where the even if you make a mistake, because the market is moving, and if you make a mistake, you have time to recover, or the market gives you the chance to come out at break even, or market gives you the chance to buy more and then average down and or scale up. So when you're already in the position and then you have a strategy to buy more on a pullback to some support level, you already have a position and you're buying more on the dip at a proper support level. So so this is where at last stage of 4 translate into stage 5. So when market moves up, like a firm, if you look at the chart, daily chart firm on Friday, so a firm started to, from the get-go, it started to do this stage 4 rally. So I'm not saying that a firm will not go to the moon, but if you're an option trader in a short term, like buy it the same day, and you may want to sell next week. But the way a firm move, it reached the top of the stage 4. So based on the analysis, it was reaching a top of the stage 4, which is between 18 and 19. So what will happen on Monday? Let's say on Monday, a firm moves a little bit up, so the leftover buyers, or they here somewhere, they get in. So they get in at the stage 5, where someone who did not sell on Friday will sell, and the retailers, they because their indicators were not lined up on Friday. Their indicators or things lined up at the end of Friday or something, and then on Monday, or they receive a heads up on Monday at open buy a firm, go long on a firm, so they buy it, and it will go up a little bit, and then it just dies down. So this is the stage 5 where the last leftover buyers comes in. This is where the Apple did. Apple stage 5 from between 194 and 198. This is what the stage 5 was reaching, and it did this on July 19 of this year at 198.23. So somebody sold Apple, and then Apple tanked. So Apple tanked and went to 173, something like that, right? Now it's trying to recover. So not sure yet. So Apple, if you look at the Apple chart, so this is where the last traders. So look at the Apple daily chart. So start of phase 5 was a cross of 194. So start of stage 5 was cross of 194. It was doing up and down, going, coming below 193, then going up, below, coming 193, then going up. And last buyers, Apple, were in, because Apple crossed 3 trillion. So now, I mean, once they cross 3 trillion, now it's going for 4 trillion. So how about 2 trillion first instead of from 3 to 4? Why not 2, back to 2? So this is where they sold, and or phase of 5. This is where they bought between 194 and 198, and this is where the distribution sets in here, and it is still going on. So now it's Apple, after crossing 173, it may be going into phase 2 and phase 3 right now, because it's from 173 it jumped to 181, and then it came down to 176, and now it's again trying uh, to recover. So what I'm doing, I'm watching Apple. I'm assuming that it's doing phase 2 and 3. So it's doing a phase 2 and 3. So I'm looking for some kind of a catalyst, some kind of a new, some indicator, something on my chart which tells me that this is the beginning of a stage 4 again in Apple. So if you are my member, you will receive an alert on Apple 4. So otherwise, what happened is this. Let's say this is Apple stage 1. So 173, 176, 180, and then it may start to do, who knows? The stock, they go in not going down, but not going up, and they do a long consolidation. They turn into a stage 7, which is like real waster of money. You're lost of opportunity. So the stock, a lot of time they do 7. They don't do, after 1, they don't do 2 and 3. But right now I'm assuming that Apple is doing 2 and 3. So, and it could be another 4. If not, then the low, the low last week of 173, etc., the break of 173 or 170, which tell me that another stage 1 has sets in Apple, and that is stage 1, a new stage 1. So it's like basement B1 and B2, and then suddenly something happened and B2 gone. So like they show in the movie, oh my goodness, now I see like, you know, big dump, big hole there, which is like 1,000 feet down. So that big 1,000 feet down for Apple, break of 173 could take it to 150. So, or so 150. So we need to look now what happened. A lot of traders, so my thought process, so what I'm telling you, the thought process, other traders may be having the thought process too. So another scenario could be that it breaks because Apple has started to bounce to 181, and then it is so people, the traders who are buying Apple, they are setting the stop loss below the recent low, the last week low. I think it was around 173. So they set the stop losses. So Apple can dip below, and then all the stop losses triggered, and then it reverses upward. So that is another indicator, another signal that yes, this is the real signal, because the recent low was taken out and sharp reversal to the upside. So what happened to the recent low? Either the sharp reversal break and continue to go down, and then it's expected to go to 150, or taken out the last week low and then sharp reversal. So the sharp reversal, when it comes, where is the signal? So the signal comes in if the sharp reversal is happening and you can identify it, that's the signal. Otherwise, the confirmation comes at 181 and above. So that could be too late. Then you say, oh no, it broke 173 and now it's at 181 and above. So how many points? 8 points. So the 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 risk to reward, that 8 points, is where you have to decide what you need. You wait for 181 break, or you wait for 173 break and the sharp reversal to the upside, or 173 break and then there is no reversal, is coming down. So it's coming down, it's setting up another stage 1. So what the market does, they create stages. They go into the sideway mode, and then they create stages. So there's something, I wrote an article on life cycle of a stock long time ago. So in that article, I talked about like a penthouse. So stage 5 is like so a lot of time. Also, it doesn't mean that when the stock goes to stage 5, it will do stage 1. It can create another stage 4. So it can create another stage 4, but what it does, it goes into the consolidation mode, and it's after all the stocks, they go and become Nvidia or Amazon or Google. So they're doing a new stage. So they're creating a stage 4 after creating a stage 5 and 6. So after they create a stage 5 and 6, they create another stage 4. So this is another. Imagine a stage 5 and 6, and then stage 4 sets in. So that's, I call it a penthouse. So you take an elevator, like you go to some building or some hotel, they have elevators for designated. So on top of, you take this elevator and you go to that floor, and then you have to take another elevator, and then it takes you to another level. So that's the kind penthouse. So stage 5 comes in, stage 6 comes in, and people think, okay, there's a distribution going on and I'm buying all the puts, etc. And then another stage 4 gets created, and the market just trap all the shots. So be very careful in 5 and 6 and 2 and 3. The most of the money is made uh, for recognizing that the market moves. Um, Rarely duration is longer than the downtrend. The downtrend is short-lived, but it's fast and furious. So the money is made quickly in triple-digit gains in the puts, sharp reversal to the downside. So this is in nutshell the stages of market life cycle. Now there are many types of reversal signals. So I wrote it down 13 kinds of reversal signals. You can study all your life trying to figure it out, all the reversal signals. Now, these reversal signals also, so this is just not one, okay, I look at this, every candle is looking like a hammer, or every candle is looking like a doji. So it's a full landscape analysis. You cannot just look at one little thing and then you say, okay, this is what it is. I'm going long or I'm going short. Well, you have to analyze in relation to what else has happened before, few months or a year, and what is happening overall. So you have to put 2 plus 2 together when you are identifying. So these are the 13 in some of the 13 reversals. So some are bullish and some are bearish reversal. So some are bullish reversal, some are bearish reversal. So head and shoulders, double top, double bottom, triple bottom, rising wedge, falling wedge, bullish engulfing pattern. So rising wedge and falling wedge. One of them is a bullish and one of them is a bearish. Bullish engulfing pattern, bearish engulfing pattern. So what else is happening when the engulfing is happening? Hammer pattern. So hammer pattern appeared, hammer candle appeared, then what else you need to know? Where is the hammer lying around? What happened before hammer? What you're looking for after the hammer? And where this candle is forming. So that is a reversal signal where it's forming in conjunction to this one little candle, or it could be a one giant hammer. And what kind of a volume is there? What else you expect after the candle? So confirmation. So what is your confirmation? So the ideally the trading, you get the first signal and then you are waiting for the secondary evidence. So I call it evidence. So there is evidence there which tells you that yes, the first was the clue, heads up, and this is the confirmation. Now there is something called inverted hammer. So this is it looks like hammer. If hammer is bullish, so inverted hammer may be bearish. So it's not. So again, inverted hammer is a bullish, and inverted hammer is also bullish. So if hammer is bullish, then why inverted hammer is bullish? What else is happening after the inverted hammer, and what happened before the inverted hammer? There's something called doji. So doji could be bullish, and doji could be bearish signal, and doji is just nothing. It's just a doji. So doji candle is the candle where the open and close is the same. So where it's happening in conjunction with all the other things that have happened in its life, in that stock's life. So where that is appearing. So doji is very powerful, but most of the time doji is just a waste. So people are recognizing doji and they are trying to trade doji. A lot of time is just a waste, but sometimes when you spot the doji and it happens early in the morning or by the market close, so it's happened in the morning of the market close, that's where in conjunction with all the other thing happen in that stock's life recently, especially recently, uh, you read that as a reversal. Now there's another one, a gravestone doji. So this is a bearish. So it's the name of gravestone. It looks, it's really it looks bearish, But what happens after this candle form? So before what happened and right after a gravestone doji form. So what you're looking for as a secondary evidence. There's another one, the dragonfly. So dragonfly is a bullish. So where it happened, it, so these patterns are appearing in you have to do this analysis of where it's appearing. So if the doji is appearing somewhere in the stock is at stage 4, then it's meaningless. Whereas if the stock is in a stage 5 or 6 and a doji appears, then it becomes more meaningful. If the doji appears somewhere in stage 2 and 3, and you're looking for you the downtrend, severe downtrend has happened, and then the doji appears somewhere here, then you say, okay, uh, I spot it as I consider it as a reversal. Now I'm looking for some confirmation. So confirmation, you're looking for some kind of a confirmation which sets a stage 4. So some catalyst, some volume building, some kind of another pattern. So on top of the doji, which is telling you this is the stage 2 and 3. So, and then the shooting star. So shooting star, it can appear everywhere. So it's considered bearish, but a lot of time it's not just bearish, it's just another opportunity to get in. It's a pullback. But if the shooting star is appearing after stage 4, you say, okay, the stock was in stage 4 and the shooting star is appearing, and I consider it as a reversal of this stage 4, then you would adopt a different strategy, a bearish strategy with the clear-cut stop loss above the high of the shooting star, and you would start to build your short position based on that, and then ready to participate when the stage 1 sets in. So depending on these are some of them. So this is not an exhaustive list. So these are some of the reversal signals, bullish and bearish. Now, the secondary confirmation, or what we can do, so the sky is the limit. When you see the reversal, you need to have some kind of a confirmation with other technical indicators, some other technical analysis, whether it's a Japanese analysis or a Western analysis or volume analysis, some kind of a secondary evidence which tells you that the reversal you spotted was really the reversal. So you're waiting for the confirmation. So waiting for the confirmation. So again, the mental state, the mental strategies, the beliefs you have, and all the psychological factors, because very hard to wait for confirmation. So this is where it sets in. Identifying support zone, resistance zone. So this is again a technical analysis that you clearly reading the support zone and resistance zone. So depending on what kind of a reversal. So if you're looking for bullish reversal, then you're reading the support zone correctly, and whether you're correctly reading it or not. And if you're reading it correctly, so supports are broken. So when the support is broken, what would you do? Would you get out, or you just hang on there? So again, your risk management skill comes in when you initiated the trade, how much risk you took. So, and the risk to reward ratio. Similarly, the resistance zone. So if you have a bearish signal, so where is the resistance zone? Are you able to identify the resistance zone correctly? So you're saying, okay, I'm going short based on this reversal, but if this resistance is broken, then I need to get out. Now, another one is the absolute volume analysis. So do the volume analysis uh, on that stock. So after the reversal signal comes in, then if your analysis is correct and stage 4 kicks in, then the volume should build up. So the volume should build up on stage 4, because this is where other big boys start to participate also. It's not like only all the big boys are invested here and nobody left. No, it's not like that. It's just that someone with the deep pocket and someone with the knowledge. So beauty lies in the eyes of beholder. So someone's we have a saying back home, uh, दिल आए गधी पे तो परी क्या चीज है. So in my language, if the dil aaye gadi pe, to pari kya cheez hai? Meaning if you they say like this, if you have fallen for a donkey, then even the fairy doesn't look good in your eyes. So that's what it is. So somebody who knows the value, they are buying it. So one big guy, another will participate here on stage 4. Someone will participate here, the second stage after the pullback and all that. And the retailer, they participate at the top, or they are here, but they eventually they keep buying, or they keep in they don't have any, they're fully invested, so they get trapped eventually in stage 5 and 6. So uh, so volume analysis is important, and then not only the absolute volume but the relative volume. So I've developed a lot of program to understand what else is going on compared to relative volume. So relative volume is very important. Risk to reward, so where is your entry, and if you have a potential, and what kind of a trade you need to put, where is your exit level. So all this, you need to, after identifying this reversal, you need to implement, and where would be the profit target, and then scaling in. Once you capture the reversal, so capturing is one point, one thing, but then how to capitalize on it. So every dip, you're reading the dip is reading in conjunction with the support. So the stock just doesn't go up like this in stage 4. They pull back, they create some kind of support. So they pull back, they rest, and then they rise. They hit some kind of a profit taking level, and then they pull back, they create certain support level, and then they rise. So how much you build up your position, and what is your trading strategy when you have caught the reversal, but did you maximize your gains? So scaling in and then scaling out. So when is the time to scale out? What is your strategy to scale out? So these are all the things which go in the trader's uh, strategy. Now here is the chart. So this is a generic chart. This is just a bar. There's no price and there's no time, etc. And there's no indicator. There's nothing here. Just a generic chart to show that the reversal signal appears, and then what uh, what would you do? What can happen? So even though the reversal signal you think is a reversal signal, was it a reversal signal, and what happened? So and then what was happening before you spotted the reversal? So so this market looks like a downtrend. This is where the reversal signal is. So you say, okay, this bar is telling me this is a reversal. So what was happening before? There was a downtrend. The market was coming down. It's not that the market was gapping up. It's just these 3 bars are showing you the downtrend. And then you spot this reversal signal. So whatever is your method of spotting it. So once you spot the reversal signal, then you're on high alert. If you think that this bar is a reversal, then you would not want to go short in this trade. You would look for the opportunity to go long. So that's what it is. So reversal, or if you are in the short, you would exit here, or you're looking for exit. So some kind of an exit you have already spotted. Maybe you took one half, etc., and then you are waiting for another confirmation which tells you, yes, this was the exit, and I need to get out. Or you exited completely after the trade, and then now you have put it on a watch list. So this reversal comes here, signal whether you were in the trade or not, short trade. So put it on the list, on your watch list, and then some kind of a confirmation. So some kind of a confirmation we need that tells us that this reversal came at correct point, and these new lows were just like fooling us. This kind of lows are coming, but the consolidation. So sometimes the stock goes up, then it goes down, it goes up, then it goes down. So maybe Apple is doing this right now. So Apple is doing this. Who knows? So I put it on a watch list. But then some secondary evidence comes, and then the market rallies, takes off. So secondary evidence may come when the Apple cross 181, or this reversal signal was just and not the valid. So there was no confirmation came, and another downfall started stage one right here. So this was the downtrending market. Reversal signal came. You exit from the short, and then it goes into the consolidation, and you're looking for some confirmation to the upside. The confirmation comes, and then you establish a long position or a break, some kind of a signal here that tells you that this consolidation break happened and a new stage sets in. So this is one example of a bottom reversal. Here's the same example, but another version of that chart. So this is another version of the chart. So this market is trending down, and then you say, okay, this is the reversal signal. So you go short. You close your short position. So and then you say, okay, I close my short position, and this is the reversal signal, and I'm waiting for some kind of evidence, secondary evidence, to go long. This could be your secondary evidence, this bar, and you went long, but then the break of the low of this, some kind of you identified some price point that this secondary evidence was not a valid evidence, and it was wrong. So the reversal signal came here, same as before, but this time the market is started to go down. So Apple can do this, another version of Apple. So we will know next week. So this is one version of Apple, let's say, and this is another version of Apple going down further towards 150. So we don't know. So this is another version of bottom reversal. The third version is a V-shape, V-shape recovery. So the market is in downtrend. So also it depends. So it depends also the power, the importance of that reversal signal. So what kind of a reversal signal was happening? So we saw these 13. So there may be more. So what kind of a reversal signal appeared? At what price level appeared? What else have happened before? And then what is happening afterwards? So when you combine all that, that's where the like a power comes in your analysis. So what happened before, where this reversal signal appeared, what it did after that, and then sudden move. So what sudden move appeared? So all that, when you combine, that's where the power of the reversal comes. So this is another, so the Apple can do this. The third version is the V shape. So V shape, sometimes the V shape happened. So again, this reversal signal, this could be intraday reversal, or it could be just on a day chart, or it could be a weekly chart. So it depends also. Sometimes on an intraday level, the reversal comes in. So the market is in downtrend, and then this reversal came, and you spotted that this is a powerful indicator. Reversal is appearing when you look on the left side. So left side, there was something else there, which was telling you that when I combine this bar and when I look on this left side at the same price point or same price zone, something else happened like 6 months ago or 8 months ago, and this bar is printing at the right price point. So when you take that analysis, then you are really waiting for this, watching it for secondary confirmation. And when secondary confirmation comes in, if you have a proper follow-up monitoring process, secondary confirmation comes in and the market starts to rally. So the market can make a V shape also. So this is where there was a bad news, and then a reversal came. You spotted it correctly. Something else have happened before, a major support 8 months, 9 months ago, whatever, or it could be a weekly chart, and then you are looking for evidence on a daily chart. So daily chart, this is the way the market is rallying to the upside, right? Now, when we turn around, that was a bottom reversal. When we turn around, then this becomes a top reversal. So top reversal signal, again, we've just flipped the chart. So whatever we saw on the bottom side and reversal to the upside, there are powerful indicators or patterns which appear at a proper place. So the location, the location. So location is very important for reversal. So the market was in uptrend mode, and the reversal signal came. So you exited from here, or you recognize it that this could be the top based on my analysis. So you're exiting or you're watching it, but there's um, no downfall. So this could be the top of stage 4. So this is a stage 4, and these bars 1, 2, 3, 4, all these bars are in stage 5 and stage 6. So here, so all those bars. So the reversal signal is coming here at the end of stage 4, and all the other bars are stage 5 and 6. So the distribution is happening here. So stage 5 and 6. So this is the stage 5 and 6 appearing here. So, but you don't know whether it will create another stage 4. It happens. So stage 4 sets in. But some kind of a secondary evidence you're looking for, which tells you that this reversal was correct, and this is the breakdown. So this is what happened to Apple. Again, I give you example of Apple. So Apple, all this from 190, the reversal signal came at 194, and this up move towards 198 and towards the 200 was a major top for me. And so I have to be very careful in Apple. So, and I send you the email on July 19th, the major top has been printed. So this is what the major top did on Apple right here, 198.23. So then the breakdown in Apple. So major signal, the reversal signal is spotted here, and then the move which was coming was this trap, stage 5 and 6, and then the breakdown. So this reversal signal give you the clue, heads up, long time, way before the market does its thing. Now there's another, sometimes the market does this. I think IBM is doing it. So IBM, I went short, and I had to close it at loss. This is what the IBM, I think, doing right now. So the reversal signal came here, and 4 days of down, and then now it's taking off. So this reversal, there was no sharp move to the downside, only like this. So if you look at the daily chart of IBM, you would spot this kind of a move is happening. So reversal signal came, but this was not followed by the stage 1. I think the IBM is creating a stage 4. So IBM is creating a stage 4 here. So IBM is, I think, about to do stage 4 here. It did a stage 5 and 6, and now instead of stage 1, it's taking off. So you see IBM is going up, and so again, beauty lies in the eyes of the beholder. IBM is doing, in my opinion, IBM is about to do another stage 4, and Apple did a stage 1, and right now we don't know what Apple will do. So, IBM now top reversal signal. So this is another opposite of V-shaped recovery. So the reversal signal comes. Suddenly, what happened? The last buyer, somehow their last buyers or somebody know their price level where they want to sell. So a major seller is there. They have their orders given to their minions that sell today. Today is your day to sell all these millions of shares. So they are selling it. Sometimes they are selling it quietly. Maybe Warren Buffett sends his, tells his deputies that we need to get out, or they could be they are someone is in a rush to sell, so they want to sell. Whatever is their reason, so they recognize that today is the day they need to sell. So market do some kind of a rally, and then it reverses, or market gaps up. So either the market is rallying and then pulling back, or market gaps up and then does the twinkle twinkle little star and it prints a doji or something. Something is there on the top. It's like the bar is away from the previous bars. So today's bar is away from the previous bar, is just does that, or some kind of a key reversal. It creates a new high but closes below in a negative. So creates a new high, and then by the time you let's say you see a new high is getting created and you are happy, you are in the long position, and then you go do something, and then when you come home after the market open, and then you look at it and then you say, what is in negative? So that is a key reversal. So some kind of a reversal bar, very powerful, shows up here. And then the market doesn't wait. Market doesn't do these kind. Market doesn't do this. Market sudden downfall. So everything was looking so good, strong chart, stage 4 and everything. And then in one day or in a 1 week, so this could be a weekly bar, or it could be a day bar, and it could be a intraday bar. It could be hourly chart or a 2-hour chart, 4-hour chart. Also, it happens all the time. So it does this, and then the downfall happens. So when we recognize, if let's say we recognize this, we initiate a position very small, because the decision we are making at this point is very crucial. We don't know if we are reading it correctly. So the time when we are making the decision to get in, whether long or short, that's the time where we are making a major mistake, because we are relying on our analysis. So there's so many things going on. So that's the time where we need to initiate the position very little, because that's the time where we can make a mistake. What the traders do, they go all in, the same as if there is no end. Tomorrow will never come. This is the last trade, and they are in a rush, and then they get trapped. They don't have any, so they don't have anything left. They just get in. So at the time when you're initiating the trade, that's the time where you are making the most mistake, because you're making some decision based on your reading. If the trade is correct, it will give you the time. Sometimes it doesn't give you the time. It just start to crash, but then you can buy more, you can short more, or you buy some more puts. Or if it just tanked the other day, next day it gap down, so what? It's okay. You have some. So when we're making the decision, we can make big mistake. We need to be very cautious. So what we learn 3 kinds of bottom signals, chart, generic. So I gave you the examples of these, some of the bearish and bullish pattern, combined with other secondary evidence, such as other technical indicators. A lot of them, MACD, RSI, stochastic, you name it. Volume, you inject volume analysis, you analyze with the support and zone, and then you set your stop loss and profit targets, and then you set in your trading management of scaling in and scaling out. So scaling in, scaling out, setting your stop loss, profit target, uh, injecting the volume analysis, absolute volume, relative volume, and analyzing the proper support and resistance zone. How recent is the support? How many times the support was tested, with what volume the support was tested. Similarly for the resistance zone, how many times the resistance zone. So are you doing some kind of a rating? So I do the rating analysis on each support. So do some kind of a rating. So do the rating. If you cannot do manually, do some automations. I've done the automation of the analysis of the support. So I get the support zone and resistance zone analysis in real time. And I rate it. A real-time analysis of the absolute volume you need to do, pay attention to the relative volume, and then the targets, and then the scaling in and scaling out. So when we initiate the trade, we need to initiate very little, and then build the position. And then these are some 3 different signals in generic chart. So you put those, what you're reading here on these. So these are 3 bottom and 3 reversal. So in today's session, we went through the emotional roller coaster of trading. I showed you, I listed 14 emotions the trader go through, and there are more. So if you Google the emotions, you get like 250 words, build a database, and then you analyze yourself what you go through. And then the stages of market life cycle, I showed you 7 stages. So each stage can be dissected and your trading strategy. So where is that market and what is your trading strategy? How much of capital needs to be invested in that market overall in your portfolio? So what is your risk in each trade and what is your overall portfolio risk on the long side, on the short side, depending on the market stage? So if its market is on a stage 4 bullish, you will be invested more on the long side. If the stage 1, then you're invested on the short side. And if it's going through 2 and 3, then you are cutting down your short position and building the long position. And when this market is in stage 7, you have you are out of that market or completely out of the market in cash. So we talked about the types of reversal signal. I listed 13, 14 types of the sky is the limit. You can do your study all your life. Trading strategies or inject some kind of a secondary evidence into your reversal. And I gave you 3 examples of bottom reversal signals and 3 examples of top reversal signals. I'm preparing a session on filters. So just to give you the brief, traders, there are many kinds of trading filters. So neurological filters. So there are psychological filters. So if you look at this, there are psychological filters I'm studying. And then there are technical filters. So technical filters, and then there are fundamental filters. So psychological filters, technical filters, and fundamental filters. So what the traders do, they apply the trading technical filters and the fundamental filters. Technical, all that what I was telling you, and then the fundamental filters, they go through analysis, let's say revenue, sales, growth, and profit margin, and all that kind of thing, which we learn in MBA, finance, or whatever, masters, uh, uh, all that. But then there is a third filter, which we don't know we are applying, which is psychological filters. So when you divide the psychological filters into 2 categories, which is actually there are 3, and it's very deep. So neurological filters, social filters, and then your biases. So all that is very complicated. I'm trying to understand. I'm trying to understand myself, and I prepared coaching material about 40, 50 pages, and I will teach you in a week or so. So you will get the heads up. I will teach you about the filters, which is very important, and we don't even know that we are applying it and how we are applying it. We don't even know we are applying and how we are applying it. Sometimes we apply it successfully, sometimes it's going against us. Most of the time it's going against us. That's why we are losing money. We are applying it and losing money because we are not aware of it. So knowing, being aware of, gives us an edge that am I applying these filters and not even know. So I will teach you in a week or so. I'm preparing. And then there is another topic I'm preparing is a mountain a trader climb. So there are a lot of things which traders have to go through in their journey. So I will teach you on that topic. And then there are many others. So I'll see you in a week. And uh, yeah, I think so. Lowe's is doing it. So based on, so I don't remember the chart exactly, but I think Lowe is doing it. Um, the market is really in a it is bearish. The market is downtrending, but then the market does its stage 2 and 3. So Friday it was the bias was to the upside on the market Friday, but there are a lot of retail stock. They are just going down big time. So retail stocks, these department stores, they are not looking good. Spread nature closing early does not garner a significant gain as opposed to naked option. So for a spread trade, I'm still here. I'm sorry. So for the spread trade, when I put on the spread trade, for the spread trade, if you close too quick, you will not make money. The spread trade is the for a spread, the target is your short strike. So if you're closing the short spread trade, your long trade is making some money, and the short trade is losing some money. So losing some money and in the initial stage of the trade. So long trade is making some money and the short trade is losing some money. So the net gain is very little. And if you close that, if you don't have a game plan and you are don't have a patience, then don't do the spread trade. For a spread trade, you really need a patience and you really need to believe the target is the short strike. So in order to maximize your gain in the spread trade, the short strike should be based on, I put on two strike or 5 point or 10 point spread. So and give some time. So your maximum gain in the spread trade comes when for the bullish spread when the stock goes above the short strike and near the expiry. What the trader do, they close too early. So that's what you're doing. I think you're closing too early. So your long trade is making the money and the short trade is losing some money, is little percentage. The gain comes in when at expiry or near expiry, the strike, the stock is trading above the short strike. So when we are putting the spread, this is another topic I plan to teach about the spread. So there are aggressive spread and then the conservative spread and then the slight aggressive spread. So your short strike should be such that you know that the stock will cross that short strike and you are giving enough time because that's where the maximum gain comes in. Otherwise, don't put the uh, spread trade. All right. So I will teach you on this topic too, on a spread. So there are different kinds of spread, the nature of the spread, depending on, again, so let me go back. So you can put on the spread in stage 3 of the trade. So you can put this long spread, bull call spread, when the stock is in stage 3 or beginning of stage 4, but then the short strike is somewhere you analyze at the and you say that my short strike will be somewhere when the end of stage 4 will reach. So you need to really wait for your short strike to come here, the stock to cross this short strike. So if let's say this is a stage 3 in the starting and you recognize it, so this is 100, the stock is let's say the stock is trading at 102. So 102 and your target is, you see that let's say 112. So this is end of stage 4. You say, okay, end of stage 4, the target is 112. The beginning of stage 3, this is 100. Now the stock is 102. So what you will do is, and then you anticipate the time duration, because it just doesn't go rapidly to the upside and hit the target. So you give some time. Let's say you say it's okay, 30 days or 45 days. So you will go long 100 strike here at the beginning of stage 4. So you will buy some long calls. So let's say you buy one contract of long call, strike 100, which is in the money because the stock is trading at 102, which is in the money. And then you say, okay, I will put on a 10 point spread. So you will short against this call in your margin account 110 strike. So now you created a 10-point spread. And then you need to give some time for the stock to go above 110 and near the expiry, 2 weeks, 3 weeks, whenever. So that's where your maximum gain is. So when the stock crosses 110 and it goes, and so the way you design your spread is the target is below your short strike or at the strike. So when the stock goes at 110 and above, this is where your maximum gain will come in. So your long call will make a lot of money, but the short strike will be losing a lot of money. But the losing of the money is less, far less than making money, especially when the stock takes some time to cross and the expiry is near. So the net gain will be 100% or more in your spread trade. Should be 100% and more. So if you put on a $4, $5, if you gave $5 for your net debit and there is a 10 point, so you're making $5 or $10. So $10. So you invested 5 and you put on 10. So you have to be patient in your stock to reach. If you close somewhere here, then you're making a 10-15% gain. And then if it doesn't work out and you're losing it, the stock falls below your long calls, strike 100. So you know and then is doing this. It's just moving up and down and up and down, up and down. So it's not working out for you. So be patient and have a proper analysis to put the short strike. All right. Good for you, Romy. So thank you. A mental stop, you say, I read somewhere the mental stop for option is 30%. So not for me, 30%. You when you put on the trade on the option is a 5-10% is the spread, and then the little bit of a stock move against you. There goes your 30%. So 30% uh, is not a good stop for option. All right. Thank you. 30% is too tight. You will be getting stopped all day long, maybe the other day. If that is happening, then you know your stop is setting the stop is is an art combined with the science. So setting the stop, if you put 30%, you're getting stopped out every day, every other day in option trading, I think, unless you are genius and your timing is so correct. So I'll see you on sometime maybe next Sunday. All right. Thank you. Bye.